Hi, I'm Russell Rivera, founder and president of Voice Wealth Management. I'm a chartered financial analyst and certified financial planner. I like to think of myself as a personal CFO and financial therapist for young professionals, entrepreneurs, and their families. Today I want to talk to you a little bit about our investment process and how we build our portfolios. We've studied the academic research and have come to believe a few things about investing. Investments should be broad-based and global. It's our job to help you do well, not find lottery tickets. In both stocks and bonds, we want you to be able to own a piece of as many different securities as possible. That's what diversification is. But we've come to believe that certain factors to certain companies might help yield better returns. The first one is about size. We tend to tilt to investing more in small companies than big ones. Well, why? Well, we believe it's easier for small companies to have exponential growth than larger ones. It's much harder for a $1 trillion company in the market to grow to 10 trillion than it is for a $2 billion company to grow to 20 billion. In our mind, it's intuitive that the smaller company would have an easier time growing more quickly. And the academic research backs this up. As a result, we tend to overweight smaller companies compared to big ones in our portfolios. Second, we look at a company's assets and see how the market prices those assets. Imagine the assets of your company were the phone or the computer that you're watching this video on now. Would you rather pay more or less for those assets? Which do you think would get you the better return over time if you paid more or less for the asset? Right, of course, if you paid less for the assets, then you're more likely to get a better return over time for a similar asset. As a result, we tend to overweight those companies where the market values their assets more cheaply as compared to others. Third, we look at a company's assets and see how they turn those assets into profits. The higher the profitability they have, the more they turn those assets into profits, the more they're weighted in the portfolio. Finally, we look to lower turnover for tax efficiency. We don't want to create situations where you have a tax bill because we needed to swap out one asset for another, or one stock for another, or one mutual fund for another. Thankfully, we have found investment vehicles that help us fulfill our strategy at a relatively low cost to you, the investor. On the bond or fixed income side, we also want to invest broad-based and globally, but we don't want a lot of company exposure. We're already providing that through our stock investments. So we tend to invest more in sovereign or municipal bonds to get non-correlated risk with stocks. Primarily, we're using our bond investments to offset company stock economic risk. If you want to talk about your portfolio, you can email me at russell.rivera@voicewealth.com. To learn more about Voice Wealth Management or schedule a consultation, you can visit our website at www.voicewealth.com. Thank you for watching, and we'll see you next time.